Welcome to the Daily Update. This is Being Prepared Thursday, July 7th, where we'll look at the action in the market today and then see how things look for Friday, July 8th. And wouldn't you know, we had a pretty solid up day and a lot of our possible positive scenarios are starting to show some light. Now, the big question is, can this continue? We have seen lots of possible setups that were positive, that the market could go up from here in 2022, only to see them go up for a little bit, like we saw in March. That was a strong gain. And if you got in right at the beginning and got out when we started to get overbought, you did pretty well then. That's when most people were jumping back in, was right when we got to the top of that. But then since that time, we have seen some other positive setups only to see them fizzle. Is that what's going to happen now? That's what we need to watch for. That's why I wait until the last part of the day to initiate any trend-based strategies. Because if you go back to the negative that we saw on Friday and that we saw on Tuesday, the market opened really lower. And it's like, okay, we're going lower from here. Well, no, we bounced back from that, both on Friday and Tuesday. Then we saw kind of a know-nothing day, but internally things improved on Wednesday. And then Thursday, we saw some follow-through now based on price action. Is that going to stick? Is that going to catch hold and go higher from here? Or is it going to fizzle out? And that's why I wait until the end, because that's as close to the close as possible to where we get the price that's going to print on the daily chart. So anyway, that's my philosophy. A lot of people don't agree with that, or they take issue with that, or you can't do that for practical purposes, but that's what I do. And that's my justification for it. The little bit that you lose by waiting when price goes in your favor is, in my opinion, what I've seen over the years is well offset by the losses that you won't absorb. Because nothing is more disheartening to go long in a position and then immediately right off the bat you're looking at a loss, and now you're defensive instead of offensive, where I like to be offensive as much as possible. There are things that are out of our control, but this allows us to maintain more control. All right, let's go through and talk about this. What happened? At the open, we had a gap higher at the open above R1, which was at 38.74. And then we went above that. And when we came back down, R1 actually served as support. As the day went on, prices drifted higher up to R2. We broke above 3,900 to 39.03. And we even went slightly above 39.03. Then going into the close, we closed almost at the high for the session. So it was pretty positive overall. But what we're seeing under the surface is also looking better. And I'll go through that with the charts. We were up 1.5%. Volume was below average. That should not really be a surprise. The technicals are turning more positive. We still have so many headwinds. Look at this list that we have here: inflation, interest rates, growth concerns, geopolitical concerns, earnings, recession fears, and those are mostly negative. Well, can we fight against that and continue to go higher anyway? What are some comments that we can make? The rotation going back into the growth sector is still holding up. The S&P was able to regain 3,900, and that's more of a psychological thing. Although one of our pivot points was at 39.03, oil's back above 100. We did see those things bounce back up slightly. Copper and tech also had a strong day. I'm not really going to show any copper charts this time. I was mainly focusing on it as it was dropping, not as it's going back up. The 10 to the 2, the 10 to the 5, both of those yield curves are still inverted. Fear, even though we're not extreme, we're still really fearful right now. The economic reports that came out were not biggies. We had jobless claims that came in about 1,000 more than expected, and the trade balance was a little bit higher than expected. Our trend, it's still negative and weakening, The bias, you could almost switch it over to positive, but I'm a little leery to do that just because of these strong headwinds that we have in the economy right now. And our momentum is more positive, but still mixed, and it could switch over negative. Are we going to see a quick retreat after we saw a good day? Let's go back and look at the day session. Here, we're at 28 now. We're out of the extreme fear category, and we're just in really fear category. And here's the historical chart showing how we're trying to come up out of that. Looking at the Chicago Fed National Financial Conditions Index, we are still climbing, but we're still below this black line. And you can go back and look and see when we went above this black line, that usually meant bad things for the economy. We also had an update of the GDP now, which they're showing a decline in GDP for the second quarter of 1.8651 right now. We also had the latest version of the AAII. These are individual investors. They're still extreme negative in the latest survey, which could be positive, but we've been camped down here for quite a while. We also have the RIDEX bear bull ratio. It ticked up a little bit to 0.11. So people are not extremely bullish or bearish right now. Here are some Isabel Net charts. This is just showing in one of these charts is inverted here. The gray is inverted. It's showing the biggest acceleration in inflation, which equals the biggest equity derating, or how we've been falling since 1974. Just gotta love these comparisons where inflation has really been going up and the S&P has been going down, but they have it inverted here. So it's just showing how the two are really moving in very opposite directions from each other. Here's another chart. This is on the bottom. It's the Bloomberg US Financial Conditions Index. And this kind of goes back a couple of years, just sees how things are going. Well, it tries to look ahead based on what it sees right now. And it's suggesting that we could go lower from here and that there was a bullish divergence in this. But what will happen with the S&P? Is it going to break back above this line, or is it going to continue to follow down? Then we have the US break-even point for the 10-year, and I have to cough. Sorry about that. The US 10-year break-even rate. This is looking at things right now, looking at how the interest rates are now, and then projecting out what do they think inflation will be 10 years from now. And it's really been declining as interest rates have been declining. Here's the cumulative change in the real S&P 500. Real means you throwing inflation into the mix against real profits. They're profits with inflation thrown in there to adjust things. When this blue area is above the black, that's bearish. That just means that we're getting really out of hand as far as profits and earnings to the price of the S&P. When we get below, this is the bull market that we saw. And sometimes it's below for a while and then comes above. Well, we've been above now for quite a while, but this has lasted for a long time. We were in an expensive market for a long time, but this is just showing that based on this chart, we're still overvalued as far as the market is concerned and could justify coming down. This is the percent of NASDAQ stocks, they call them constituents, that are down 50% or more from their highs since 2020. And it's been increasing overall. But again, you could take some different data and justify that the NASDAQ's kind of in the lead right now. That's what we're seeing. We saw it yesterday, and we also saw that today. Then you take the consumer sentiment, which is very low. That's the dark blue line, where people have never felt this bad as long as this survey has been conducted. And then compare it to the Russell 1000 index of the trailing 12 months, TTM of their growth. No, it's not TTM. It's the 12-month gross profit margin. And it shows how these two are really out of line from each other, where we've been going up with the profit margin, but we've been really going down as far as sentiment is concerned. They have a tendency to move more in the same direction. Are profits going to start coming down, or are people going to start feeling better? You know, get happy, whether you like it or not. then this is showing that maybe inflation has peaked right now. And I don't know why this red line is in here. And it just says, according to this chart, we estimate that the boost from the commodity price increases to year-on-year core PCE inflation will decline from the second quarter of 2022. That's where we're at right now, into the fourth quarter. That's the end of the year. And then it'll also decline going into the fourth quarter in 2023. So just kind of looking into the future, where they think right about here, where I have the cursor, that maybe inflation has topped out and it's starting to come down. That could be positive, and that could change the scenario. But are we going to go into a recession or not? Then here's GDP. According to Goldman Sachs, we had the 1.6 decline in the first quarter. They're suggesting that we're going to be up 1.9% in the second quarter, and then also have positive GDP for the rest of the year. Here is a comparison of the VIX, which measures stocks and the volatility of stocks, against the move ratio, or against the move indicator. And that compares, or that measures, the volatility of bonds. And it just shows where VIX, so the ratio on the left, that's what we're going against here. It just shows where the volatility in stocks has really been decreasing on a relational basis to the volatility in bonds. And in yesterday's chart, I showed a move chart that showed that bond volatility has just been skyrocketing lately. Then this tries to measure the recessions that we've had going back to 1860, go back to the Civil War era. And all these dark lines are just when we've had recessions. Well, all this chart is saying that our recessions are fewer and far between now. All right, so let's go in and look at our charts. Here's the VIX with an up day like we had. We saw a decline based on the line chart and the bar chart, and we closed kind of in the middle. We were a little bit lower with the VIX earlier, but we still declined overall. And the VIX of the VIX continues to decline on the bar chart and on the line chart. The Ulcer Index is also dropping off, showing that this is not measuring a lot of fear right now. And I need to clear my throat. Sorry about that. We're down 19.01%. So right now we're out of bear market territory, but we still have a lot of making up to do if we're going to turn things more positive. The equity put call ratio, it did decline on the up day, which is not necessarily surprising. And the 5-year is starting to go lower. The 5-day moving average is starting to go lower. Looking at our support and resistance, here are the pivot levels for Friday. And what I'm assuming is those of you that use these or find these valuable, you pause the video and maybe look at or write down these numbers. That's why I go by them kind of quickly. Then here's the daily chart showing how we got above the pivot point. So that was positive. That's what we were looking for. You can see how we dropped off in volume. So those people that are real bearish on the market are going to be quick to pick that out. And they're right in that case. When you see an advance on lower volume, you're a little bit suspicious of that. Here's our machine gun chart where we're breaking above this longer term, well, had been resistance, but we're still above the support here, but we have some other resistance still above where we're at. And here, this is also showing we're staying above this support level for right now. Here are the pivots for the month. And again, I'm assuming that you pause this and maybe look at these points. And if you don't know what they are up here in the corner. If they're hard to read, send me an email. I can quickly tell you what these pivot points are. And the Fibonacci levels, it's also showing that we're going back above this fib retracement. That is acting as support, and we've been able to break back through above that. So that is positive, but we still have a lot of overhead resistance. And if we do end up going higher from here, we're going to have a lot of overhead resistance because we're going to be meeting places that were lows or intermediate term lows that we're going to bump back into that had been support. And now that we've fallen through them, they will become resistance. And we're still above this 38.2% retracement on the weekly chart. And here is the 200 week moving average. Looking at our sectors, the energy sector did the best, and discretionary and tech They were up pretty strong. There was only one sector that was down, and that was utilities, and they've been doing kind of well lately, but they were down. And then here is the scooter rating to look at these from a technical analysis standpoint, where energy, utilities, and healthcare, as well as staples, they are in the 90% or the 90 range, I should say. So they're getting a pretty high technical analysis score, where we're seeing some improvement from communication and discretionary, but they're still in the teens, as is materials. Then here's the chart that I show every day, showing how energy is the sector that was the best performing. Utilities are still slightly positive, with all of the rest of the sectors negative. And then this is a new one, and I don't know if you'll find this useful or not. We are this kind of dark blue right here. Is that a gray, maybe? It just shows how the S&P, since the all-time high, how it has performed compared to the other indexes, where the Dow has held up a little better, followed by the NYSE. And I'm sorry, we're pink. We're always pink. I'm looking at the small caps. This is the pink one right here. And the NASDAQ and NASDAQ 100 are the ones that have been having the most trouble. Our technical alerts, mostly positive. The one for the S&P was that we got back above 3,900. There were some other positive indications that we saw as well in other markets other than just the S&P. But we're seeing a lot of improvement in the S&P. So that's why in this video, I'm focusing more on S&P charts. I'll still show some other ones, but we're seeing more improvement within the S&P. So here's the gap that we saw higher. We gapped above R1. And then as we came back down, R1 acted as support. We bounced up off of that, kind of drifted higher, got all the way up to R2, went slightly above R2, and then came down in the close. So we finished off of the highs, but near the high nonetheless, and are above 3,900 right now. Our trend, as we've been going up, the ADX has been going down, but it's still above 20. But we're seeing the green line really go up as the red line is coming down. If we see more days, there's a potential that these could cross. Looking at breadth, also showing some improvement based on price and volume. The advanced decline ratio is above 0, so that's turning more positive. The new highs and new lows were looking better yesterday. Well, they went up a bit more, and they're turning more positive. Accumulation distribution also looking more positive now. Some of our short-term charts, here is the 20-period moving average. We regained the simple moving average yesterday. Well, we regained the exponential moving average today. So we've got a lot more moving averages to go, as witnessed by this, where we're still a long ways below our moving averages. But hey, you've got to start somewhere if something is getting ready to happen. And then here's our rainbow coming back up into the bottom of the 10 and the 20, where we still have the 30, 40, and 50 above where we're at right now. Stochc RSI also giving us an extreme positive reading after not much of a move. Williams percent R, and these are pretty touchy indicators, but they can stay pegged extreme positive or negative for a long time. But we're starting to get extreme positive. The force index is more positive. The Swinland trading oscillator, it was kind of leading us a little bit. It turned up a little bit before we saw price start to turn up, and it's still positive. McClellan oscillator is also positive. And the 20, 50, and 200-day moving average study is showing improvement. Stochastics starting to get extreme in the short term, looking okay in the intermediate term, trying to turn back up in the longer term. Some intermediate term charts. We're still above this anchored moving average going back to the COVID low. And that's kind of significant if we can stay above that. And then the PMO study, we're looking pretty positive across the board. We finally saw volume cross over positive. PMO study, getting a little extreme with the PMOs that are rising. We're seeing the buy signals improve, and the percent that are above 0 is also advancing. Chaikin oscillators also advancing. Chaikin money flows kind of not really doing much. It actually declined a little bit. And I don't know why some of these charts are hanging as I change from one to the next. The volume intensity continues to fall lower because we're below average. The vortex is it switched positive yesterday and is still looking positive currently. Summation index is up based on price and volume. All of our oscillators have now switched back to positive and they remain positive. Bullish percent index, after going down below 30, came back above it yesterday and showed a slight advance. Not really big, but it did move up slightly. Ease of movement actually ticked down a little bit. Ultimate oscillator showing a bit of an uptick. I haven't shown this in a while. The CCI 14, we're starting to get into extreme positive territory. The TTM squeeze is still showing some improvement. Our different charts, here's the Heiken Ashi. We now have a couple of open candles here. That's more positive. The Kegi chart really hasn't changed, but it's still looking positive. And we don't have a new signal with the point and figure chart, but we have a couple of new green X's in here now. Our different trading systems, the Elder is still positive for the SPX and the SPY. SAR continues to be positive. And the go, no go system is still more negative neutral since it's the lighter shade of purple. Isn't that a song? No, I guess lighter shade of pale. And the moving average study, longer term, ticking up with the 50, 150, and 200. And the special K, even though it's negative, is trying to turn up ever so slightly. Looking at some broad market issues, I brought this up yesterday, asking, can the Dow break through the pivot? Yes, it did. Now, can it stay above that pivot? Can it get back up to the moving average? And here's the diamonds, which are now positive. The Wilshire, the same thing. It got above the pivot. Can it get up to the moving average? Can it stay above the pivot? The Qs are back to positive and kind of leading the way right now. Here's the NASDAQ 100. It's getting up to the moving average where it was above the daily pivot after yesterday. Well, it showed even some more strength in today's session. And here's the Vixen, where it's showing a decline with the bar chart and on the line chart. And here's the NASDAQ. It's also breaking above and starting to get back to the moving average. You got to start somewhere here. Broad market, the dollar was up slightly, virtually unchanged, but up a few ticks. And the dollar to the S&P is still neutral as we're attempting to go through this potential reset of how the market's been behaving over the last week or two. Maybe it might be readjusting to something new. And oil went back above 100 to settle at 102.73. The ratio or the correlation between the S&P and oil is now still neutral. And looking at bonds, the correlation, it's still kind of more or less neutral when you compare the S&P to the 10-year yield. And the tech sector to the 10-year yield, it's more in the same direction where they had been going in the opposite direction currently. And we still have a couple of yield curves that are inverted. Here is the 10 to the 5, which is now inverted, and the 10 to the 2-year, which I'm sorry I don't have a label on here, that is also slightly negative. And this is the one that people pay most attention to. We are coming back up with the 30-year yield. Now we're going back above 3%. And what had been resistance, we broke through that. It had been support, we broke back down. Now it's breaking back above that again. And here are the yields. They really went up in today's session. Here we go with our possible positive scenarios. And I've added some charts that I haven't talked about in a little while. Here's the 10-day average of the S&P highs minus lows. We had an extreme negative reading. And if you go back and look at the chart, sometimes this marked a significant low in the S&P. We're starting to bounce up out of that now. Also, looking at those percent of stocks that are above their 200-day moving average, it didn't get quite extreme, but it gave us a really low reading and starting to bounce up out of that. And if you look back, you'll see that that also marked a low in the S&P. Here is looking at the S&P with the stocks above their 50-period moving average. Again, went extreme and is bouncing up. And just for some more confirmation, mid caps went extreme and are bouncing up, and small caps were extreme and are bouncing up. So we're seeing across the board type possible confirmations here. Well, they are confirmations. It's just, is it going to lead to something powerful? This is another chart that I kind of stopped talking about because really nothing was happened. We had really spiked up with the 5-day simple moving average of the VIX right in here. And if you look back, when we've had a spike in the VIX with the 5 period, that has often marked a low. Well, we kind of came down here and then we're just bouncing around like a ping pong ball. Well, we're starting to drop a little bit more now. The Copic curve generated a signal that's still on the table for us. And the Pring bottom fisher is generating a signal which is directional, which suggests that we may shoot up out of this. Our different sector rotation also continuing to improve with the Qs, discretionary, and the large cap growth versus large cap value. All of these charts are starting to show an improvement, and the growth versus value with the large caps, mid caps, and small caps are all showing an upward tick. So this is back on the table now. The 2-year Treasury spike. We've been coming down with the 2-year Treasury. Can that mark some kind of an intermediate or short-term bottom in the S&P 500? And then looking at the S&P 500, the 2-year correlation, they're kind of going in the same direction right now, but still a little bit more towards neutral. The staples sector, want to keep an eye on this. We're still below both of these moving, well, we're below the blue moving average. Are we going to see a death cross here? This has been the sector that's really performed well in 2022. It's actually done well in 2020, 2021. Is it starting to roll over? It would be the first time it's done that since the COVID plunge. And then here's our staples ratio look, where it looks like we spiked up and now we're coming back down. So this could be a spike right now, which again, if you look at other spikes that we've seen, have marked a significant low in the S&P. So what's our outlook then for Friday? The technicals are turning positive, and our sentiment has gone from extreme negative to just really negative right now. We have the jobs report, and this is the biggest report of the month, the employment report. And that'll be coming out at, what is that, 8:30 a.m. Eastern time? I'm used to West Coast time. We also have wholesale inventories and consumer credit. Those aren't real biggies. It'll be the employment report that'll get most of the press, and they like to talk about that. And all of our different geopolitical events that are going on. And I'm not going to read these off. Just pause the video if you want to look at these, because I get tired of reading the same thing. The big one right now is still the recession fears, the very last one on this list, because we don't really know. Are we going to go into a recession? Is that going to be a game changer? Are we going to be able to avoid a recession? And that could give some real support to the market. Our scenarios, and I've got another different color here. Yeah, we could still go down from here, and that's kind of the prevailing attitude right now with all the reasons that you see right here why we could go down, but the technicals are turning positive. And I switched this over to yellow, more like a caution, because we could be switching over to an up scenario. The technicals are turning positive, and nobody really believes that the market can go higher right now. We're looking at our possible positive scenarios and our sector rotation, and they're showing some improvement as well. And our technicals are showing a lot of improvement with the pivots. We regained the 20-period moving averages. We look at the fib retracements and then previous highs and lows. And we're not really in a neutral market right now unless you look at the ADX being below the moving average and you're more aggressive with the ADX. If you're more conservative, you're still saying that we're not necessarily in a sideways environment. So our conclusion then is the S&P is turning positive, but can it stick? That's been the answer. We've been not really here, but we've been to places like this before in 2022. Is this one going to be the one that finally changes things? Or is it just going to go back on the memory heap and saying, well, that one didn't work out and now it's off the table? Short term, we are still negative overall, but turning positive. Same with the intermediate term. And we're still negative in the long term because we're below the 200-period simple moving average. So thank you. Have a really, really good Friday. I will prepare the video for Monday after Friday's session. I usually do that at the early part of the weekend, so there might be a bit of a delay with that. So have a really, really good day, and I'll talk to you in the next video.